Welcome to TheoTrade. This is Don Kaufman. April 14th, 2022. 5 minutes left to your trading week. Heading into a holiday weekend. Are you prepared for the coming volatility storm? Let's get right down to it. A brief market update. Again, we're seeing some volatility here on this Thursday afternoon. SPOOs are off some 51 handles. Nasdaq getting absolutely killed, down over 2% on the trading session. But I'll tell you what, it's all for nothing unless you're looking at the bond market. That is the entire marketplace at this point in time. You can talk about S&Ps, you can talk about individual stocks, we can talk about Elon Musk and Twitter, but that is not what is at the forefront of what is becoming an absolute volatility storm. And we're really, again, we're seeing right at the bleeding edge of just that. So let's get down to business here. Again, NASDAQ coming off, again, hard and fast into today's closing bell. Volume starting to surge as well. And one really critical aspect, everything that we're seeing in the marketplace, we are right here, right now, below the SPX expected move on the week. Again, we are below the SPX expected move, which is indicative of right into the cash close here. You are seeing ultimately gamma risk play out. They're going to sell into sell side activity. Now, can't be surprised. Oh, we're going to bounce, we're going to sell off. But right at this particular level, all right, sell side activity becomes rather extreme. Again, what you ultimately have is gamma that is going to push the entire dealer side, that is the market maker side of the business, to have to sell into selling. Why? Because we're outside of, again, the expected move. Expected move this week is right around $76. And again, a shortened holiday week of trade. Nevertheless, it's the first time, again, the first time since we've seen a breach of expected move since, well, right back here, just about a month ago is the last real breach we saw of expected move. That was a breach to the upside. Here we are, most unequivocally, we are going to close outside the expected move. We'll talk about that in just a moment. To summarize everything that we've seen in this week of trade, we could look at some of the bank earnings. We could start in the financials, and obviously some of the financials earnings. JP Morgan was a little bit of a surprise to the downside. But when you start to look at some of the other earnings, Citigroup, Citi actually, beat, but the stock is right now, it's been fading throughout the course of the day. You look at Wells Fargo getting hammered a little bit. It's a bit of a mixed bag of goods for what was earnings that, well, were not half bad. In fact, we could even bring up Goldman Sachs, which is going to finish the day massively unchanged. But I'm telling you right now, it's all for nothing. Everything in this marketplace right now hinges on what is interest rates, bonds. They're completely out of control. Now, the bond market, because we're coming into a holiday weekend, the bond market, they shut them down early today. It's bankers' hours, right? So they shut the bonds down early today. You can see the bonds just went flatlined. All right. And when I say went flatline, they stopped. Basically, the cash market closed at that's 10 a.m. Pacific time. The bond market actually they shut them down. There's still electronic trade obviously going on, but the bonds, they broke. They broke. Interest rates are rising, and they're not just rising. They're absolutely exploding. And by the way, we're going to come back to that here momentarily. We are watching. Again, markets, they're coming unwound right now into this cash close. There's 54 seconds left. This thing's not going to close a moment too soon. This is exactly what I'm referencing in terms of gamma risk. The dealers have to sell into selling to mitigate exposure outside of that expected move in the SPX. I mean, you're even seeing price action, late in the day. I mean, it's everywhere in this marketplace. Even volatility starting to come up into a holiday weekend. You've actually got volatility bit. Doesn't exactly leave you too warm and fuzzy. All right, back to business. As I said a moment ago, rates, they're completely out of control. To kind of quantify what I'm really referencing on that front, I want to start with the ZB. The sell-off has been immense. It is absolutely Relentless, though, at this point in time. Here comes the closing bell. There's the closing bell of the day. Relentless sell-side activity in the bond market. And again, I just don't think that that necessarily does it justice saying it's relentless sell-side activity. But when you start looking at the bond market, obviously this thing can't catch an uptick to save its life. Now, I've even placed a few mild bullish trades specific to the TLT. The one thing that cannot be overstated in this particular point in time, it's not even so much about the bonds, all right? It's in reference to the interest rates. So here happens to be the 10-year, okay? So it's US Treasury, it's the 10-year. It's actually all the way flying basically and closing at about 2.8%. I was doing this on a lot of recent videos. When you start looking at this, though, on a year-to-date basis, you're talking about the 10-year flying up by approximately 73% on a year-to-date basis. So time out for a second. So what am I telling you? Interest rates have actually flown to the point of they're up basically over 70% just since the beginning of the year. It's again, it's a phenomenal move. Again, to kind of further this just a little bit, this is actually the Treasury.gov, U.S. Department of Treasury site. And you can see just over the last couple of trading sessions, again, I'm going to highlight a few of these because it's critical to understand how significant some of the moves on the screen happen to be. I mean, we're talking historic moves right now in interest rates. This is just the month presently of April. You can see even the 1 month, okay, from 0.15 to 0.37. Forget for a second that inversions of the yield curve are even transpiring. So we inverted, we uninverted. It just that's again, put it on the back burner. Okay, that's an old story. The story right now is when you start looking at a 10-year, all right, at 2.83. And again, this is today, all right? The bond market closed early, so you're literally looking at today, where the 30-year is jacked now to basically 3%. And again, even more alarming than that is when we actually switch this. That's just the current month. Look at all of 2022 and hit apply. Okay, the beginning of the year, and again, we're all the way back to January. Beginning of the year, you're like, oh, whatever, man. The 10 years at 1.6, and you scroll out a little bit here, and you realize the 10-year now is again rapidly approaching the 3% mark. These numbers are phenomenal, and at some point in time, you ask yourself, okay, what's going to break? What do you mean, what's going to break? Interest rates are exploding over here. Yield curve is moving all over the place. It inverted and uninverted, but again, with this exploding, what's it going to break? Is it going to break a couple of traders? You're going to see some hedge funds possibly explode, because when it comes down to it, I think the best way to explain this, if you looked at oil, right, and obviously all the geopolitical risk happening in Eastern Europe, you looked at oil, and oil shot to $130 a barrel. There were several big funds, individual investors that got just absolutely decimated inside of the move. But the move transpired very rapidly. It abated. Okay, it's over and done with. Yeah, we're not looking at one commodity product. We're looking at a phenomenal size, I mean, a full-blown crash inside of the bond market right now. This is the US Treasury. It's the entire credit marketplace, right? People, we're just not doing it justice of how much damage is going to be inflicted by this. And I have to tell you right now, even though the Fed, you're like, well, the Fed, they've raised rates one time. They've raised rates, but the bond market seems to be doing well what the Fed has not. The bond market just gripped hold. There is just wicked sell side. Nobody wants to touch this thing. I'm telling you right now, even if we were to stabilize and bounce back up, there is tremendous damage that has been inflicted. And I start asking the question, like, where is that damage going to be inflicted? I mean, you could look at the home builders. There's just no question. All right, so there's going to be the home builders. And all right, so the home builders have had some damage inflicted in the year-to-date percentage. They're down about 27%, right? You can bring up Home Depot pretty much to your blue in your face. You pull up individual stocks. What you're not seeing, though, is the impact in the entire trading community. You're not seeing the impact in the fact that the financials at this point. All right, so the XLF is only down like 6%. That's because Berkshire Hathaway is still functioning fairly well. Start to look at stuff like Goldman Sachs, it's down almost about 20%. You start to look at individual banks like JP Morgan, all right, it's down some 22%. So even the financials, aren't they supposed to do well in a rising interest rate environment? Of course they are, except they're already setting aside capital okay, for losses. JP Morgan literally said it. That's one of the things that I don't think enough people, again, are kind of focused on. They set aside, I believe it was $900 million, which is nothing. It's a drop in the bucket for JP Morgan, because they see basically storm, on the horizon in here. That's, again, it's not even my cause for concern. The cause for concern over here is rising rates are going to break markets. Specifically, what they're going to break, in my estimation, it's going to be monsters of tech. Okay, you can't make good reasoning, all right, to be buying back stock if you're on the board in a rising interest rate environment. There's just no good reason for it, and you're going to start to kill off the ability for some major products ultimately to be able to buy back stock. So, I mean, do you really want to buy back stock and do a bond offering at like 4 or 5% to be able to buy back stock? It becomes difficult on the board to be able to justify that. Or you could be like a degenerate borrower, maybe somebody like Tesla. Now, Tesla, I mean, just recently in the last couple of years was considered junk status, and at this point in time, there's huge debt on the books. Obviously, earnings are right around the corner, neither here nor there. But again, the music is stopping in terms of a low interest rate environment. In fact, again, I want to bring up the TNX and recognize that we're actually going to put up the max chart. This is the max chart available to see the magnitude of the move. And you recognize that how many of these firms that are out there, they've never even experienced really a rising interest rate environment. At what point, I mean, do you see a rising rate environment? I don't know about you, but I'm starting to think there's a little bit of a trend over here. That is the significance, though. I mean, what I want you to see is just how wild of a move this really is that's transpiring literally like right now inside of the marketplace. Nowhere else do you actually see on here rates exploding like they are literally, if you would, the last 2 months. We're into a monthly chart on this particular case, just max chart on the TNX. You can even bring up the FVX, which happens to be the 5-year, okay? Nothing is even comes close to the magnitude of the move of the 5-year. And again, I emphasize this because we are absolutely unequivocally, we are at that breaking point. All right, we're seeing it transpire again as we speak. I mean, that's what the S&Ps are feeling it, but the Nasdaq is feeling it even more. And we're starting to see the unwind of, again, a number of major tech stocks. And I think you have to have cause for concern. Microsoft is now down some 16%. Why do you have to cause for concern there? The spider's only down about 8%. Okay, how could the spiders be outperforming so well? Because there are sectors, right, like the energy sector. If you haven't looked at it, it's still up 40% on a year-to-date basis. Right, this is a small sector, but it's kind of bidding the entire marketplace at this point in time. There are too many avenues to even consider or even to mention with a rising rate environment. But again, if the rates continue to rise, that is, if bonds continue to sell off, if notes continue to sell off, all right, you start to really see a complete and utter unwind of the S&P 500. Serious volatility. The other thing to consider is if we take a look at the TLT, and again, I don't want to go into incredible depths on here, but if you take a look at the TLT, the volatility in the TLT, for instance, 30 days out is about 24%. Compare it to VIX. And again, all I want you to see is, how wild things have really gotten. This has been something that's been fairly consistent the last couple of weeks, but bond volatility is still exceeding S&P volatility. Again, that doesn't make me feel warm and fuzzy when the credit market is coming apart at the seams and the S&Ps are like, whatever, which is exactly what we're going to talk about next. And that's, why is the VIX dead with risk risk is barreling down in the markets. Take a look. When was the last time you saw over a 1% decline in the S&Ps? What did the VIX do today? Absolutely nothing. I mean, the VIX today, it bid up into what? Oh, the last 10 minutes of trade when, there was fear and loathing in the last couple of moments of trade. But ultimately, you're seeing nothing here. And I'm going to tell you exactly why. Why? Because we've seen this movie before. We've had a lot of chop, okay? Some short-term volatility. But I am telling you right now, we are, this past week of trade, I was talking about we are at this crossroads in the market. Well, we're starting to pass through that. And right now, again, it looks like there's about to be an absolute volatility storm hitting this marketplace. If there's one thing you need to be a little concerned about, the VIX is low. And the VIX is low because ultimately, we've seen this movie before. I mean, to trade at 4,400 in the S&Ps, that's an old gimmick at this point. We've seen it. We've seen it what? Well, we're back here in the January timeframe and most of February, and oh, we escaped a sudden death here in the beginning, of course, of March, only to rally back up. But now it's on. But until we actually see something new, something really scary, we're not necessarily going to just descend off into the abyss. We'll start to descend, and volatility may not come raging up until it's too late. And you've got to be careful at this point in time. Why won't volatility rage? Because it's seen this movie before. It's seen 4,300. It's seen 4,200. You got to do something new, something spectacular to get volatility raging again. And it's why I believe that the VIX is relatively dead. On the exact same front, we're going to cover that again in just a moment, because there's a critical portion of the VIX not necessarily going up with markets starting to slide. Now, another week, again, on the edge of expected move. As I actually kind of kicked off over here, I was discussing this because, again, the hedge started pushing us outside the expected move. I mean, the entire trading week. And I mentioned this, numerous times, even last week. I'm going to go to a 10-minute, and I just want to show you the last, for instance, 10 days in the S&Ps. You have to recognize that, and I talk about expected moves just incessantly. Throughout the course of most of last week, we just rode on the edge of the expected move. This week, Monday on the edge of the expected move. Tuesday, Wednesday, we bounced a little bit and then came right back off to the edge of the expected move, but we broke, and we broke below it. That, people, is actually a sign of, again, as I said, markets kind of pulling apart at the seams a little bit. This is critically important. It wasn't a huge breach of expected move. I mean, come on, we're supposed to be the edge of expected move is 44.12. Where did we end up? 43.92. It's a hop, skip, and a jump outside. I mean, less than 20 handles really outside the edge of the expected move, but it counts. It absolutely counts. Again, another week, though, of the edge of the expected move and riding it, okay? Only see some sell side. Now, how do we position ourselves in this marketplace presently? First and foremost, as I was talking about volatility pretty extensively and talking about credit markets, the treasuries, selling premium, tread lightly. Listen to me, okay? And you know what? Just look at my positions. I got lots of positions on right now. But when it comes to the sale of premium, I am way underallocated. And I'm going to tell you specifically why. I'm underallocated because I don't like the price action I'm seeing in the S&Ps. I don't like the fact that the credit markets are coming apart at the seams. I don't feel like I'm getting paid for it inside of volatility. Now, I don't necessarily sell short-term, 30-day vol in here of 22.66. Okay, that's just not for me. I'm selling much more duration premium. But for the most part, I see, again, a bit of a volatility storm coming. And I want to walk into it, all right, eyes wide open. I want to sell into raging volatility. The only problem is we see the selling picking up. We don't see raging volatility. Even looking at the volatility futures, and why I'm looking at the volatility futures, are we actually headed, okay, into, for instance, backwardation again? No, we're still a point apart. Again, what's to take away from this is that the marketplace is even telling you, we've seen this risk before, we'll get there and volatility will rage, but only when we see something absolutely hideous. All right, on another front. So again, when it comes to selling premium, tread a little lightly. You can absolutely allocate, but you should be grossly underallocating, waiting for that volatility storm. All right, next on this docket over here, we got to sell what's strong and let correlation grip hold. This is actually where I'm going to look at the correlation coefficient. I've been talking extensively about this. It is not a good sign when you're looking at the S&Ps that are down 1.3%. The correlation coefficient, though, we're not home yet. There's still some strong points in the marketplace. When I say sell what's strong, let me get really into detail over here. Look at stuff like Walmart. Okay, Walmart's down basically 14 cents. You go, it's a wonderful, what is this? Like the latest, greatest tech stock? You would think Elon Musk was taking over Walmart with the size of the move. Look at the magnitude of the move inside of Walmart. What is this? It's called duck and cover. All right, pays a little bit of a dividend, yada, yada. Walmart is moving straight up. Take a look at XLU. All right, talked about XLU last week. Was moving ultimately straight up. It's completely stalled out. I would look at shorting products, right? Maybe you don't have to short Walmart or XLU. You could look at stuff like XLP, All right, XLP straight up. What is XLP? All right, for those of you that don't know this, it's Consumer Staples ETF. Why would I look to short what is incredibly strong? Because when the volatility storm comes, they're not going to hit, okay? They're not going to hit 68 stocks. They're going to hit them all, right? And we're going to correlate and we're actually going to smack that marketplace down very cohesively. So what you want to look for at this point in time, when I say short, you don't have to go out and outright short the XLP or short the XLU or short Walmart. You can actually use in-out spreads. There's a variety of different strategies. We can actually take duration positions using deep in the money puts. But again, all right, I want to short some of the strongest products on the screen right now, especially okay, when fund managers are like, just throw money into it, it'll all be okay. You know what you're actually seeing right now is fund managers throwing stuff into low beta. Okay, anything with low beta is like rocking to the upside right now. And guess what? Low beta, and I'll bring this up kind of historically here for a second. Low beta still takes a whole lot of risk when volatility hits the fan and we start to correlate. Keep that in mind. Last but definitely not least, on this weekend update here, well, what we have again is a breach of expected move. Now we just came off a 4-day trading week. Again, it's Thursday. It's Thursday. Markets are closed for Good Friday, the Easter weekend. We just came off a $76 expected move, right? The expected move in the SPX. What is it? Okay, this is the absolute perfect time to look at it. You wait until basically 15 minutes after the closing bell, all right? You look out to the next expiration. The next expiration in this particular case is on April 22nd. You're looking at about a $98 anticipation of movement. All right, so what do we learn from that? It means put your helmet on, people. I'm telling you, all right? There's a volatility storm coming. If markets start to bid up early in the week, we're going to fade them. Again, walk into that marketplace, tread lightly when selling premium, look to short what's been incredibly strong, especially consumer staples over there, be just fine. Thanks everybody for joining us here at TheoTrade. Have a wonderful holiday weekend. Bye-bye.